Okay, guys, welcome to this week. We are going to cover chapter 6. Now, guys, in my opinion, chapter 6 is easier than chapter 5. We're talking about inventory and the different methods of being able to show costing for inventory along with cost of goods sold. So if you have questions, those of you online, feel free to, comment. I'm assuming right now everyone can see my screen and hear me, correct? Yep. Okay, guys. So what we're going to start talking about is inventory. Inventory is the asset that is manufactured or is purchased, and the purpose of inventory is to sell it to customers. So we're going to talk about various types of inventory and cost of goods sold. So we know inventory, if you are a manufacturing company, you purchase various raw materials in order to make products, ultimately for sale to sell to customers. Items that are still not finished are included in an inventory, and we're going to talk about that. Inventory is a current asset on the balance sheet. Once inventory is sold, it no longer is on the balance sheet. It becomes an expense called cost of goods sold on the income statement. Remember, inventory is an asset. It's on the balance sheet as a current asset. But when those products do sell, it becomes goes onto the income statement as an expense called cost of goods sold. So we see here that when you are a merchandise company, you purchase inventory that is already completed. And ultimately, you sell that merchandise as a wholesaler or as a retailer. Manufacturing companies have a couple types of inventory. The raw materials would be considered inventory, and it's the materials to make the products. As the products are being made, those raw materials get removed and are put into another inventory account called work in process. The work in process account is used until the goods are completed and ready to be sold. Once those goods have finished all their manufacturing, they are moved into finished goods. It is these finished goods that are able to be sold. So know that merchandising companies versus manufacturing companies have different types of inventory. You'll learn a lot more about manufacturing and the various accounts in managerial accounting. How many of you have to take that next semester? Anyone? Managerial accounting? One? No one else does? A couple. Okay, I'll see you next year in that next fall. So here you see a partial balance sheet showing how the inventory looks for a manufacturing company, Intel, how they show raw materials, work in process, and finished goods. And then you also see Best Buy, which is a merchandising company, how they just have inventory already completed. So we know a manufacturing company takes the raw materials, adds the direct labor and some manufacturing overhead to produce various types of products. In this case, it's a computer. While it's being completed, it is in an inventory account called work in process. Once that product is completed, it then goes into finished goods. It's available for sale. It can be sold to various manufacturing or merchandising companies who in turn sell it to the end user. and use it for in school here, use it for services. You know, it's a piece of equipment that is needed to perform their jobs. If I didn't have a computer, it would make doing income taxes very difficult. So remember, guys, service companies record revenues when providing services to customers. Merchandising and manufacturing companies record revenues when they sell inventory to customers. So we're going to take this first question. Which of the following inventory accounts consist of items for which the manufacturing process is complete? Anyone know?
Is it D?
What did you say?
I said D.
D? Are you sure? You're right. Excellent. Finished goods is the inventory account that is used when the product is ready to be sold. Work in process is the account that is used as the product is being worked on and completed. Now, cost of goods sold is an income statement item. Inventory is a balance sheet item. Inventory is an asset. We are going to have beginning inventory along with purchases during the year give you total inventory that's ready to be sold. But at the end of the year, you either have it's still sitting in ending inventory or it's sold. So know this slide. Inventory plus purchases is total inventory available. Then the total inventory available will either be sold or will still be in ending inventory. The item sitting in ending inventory is an asset, current asset on the balance sheet. The items that are sold is an expense reported in the income statement. Again, I'm kind of highlighting this, but inventory is a current asset. The items sitting in that inventory account have not yet been sold. But when an item is sold, it transfers out of inventory, or inventory is credited. Cost of goods sold is debited. Okay. So what about this one, guys? Cost of goods sold is A, reported in the income statement, B, reported in the balance sheet, C, a current asset, or D, the cost of inventory on hand at the end of the period.
A.
A? What about everyone else? What do you think?
A.
A? Awesome. Excellent, guys. It's reported in the income statement. Here, you see something that is called a multiple step income statement. And the reason it's called a multiple step income statement is because it shows you different levels of profit. It shows you from revenues minus cost of goods sold, shows you gross profit. Then after various selling and admin expenses, it shows you operating income. Then after various other income and other gains and other expenses, it shows you income before income taxes. And then with the income tax expense, it shows net income. This is called a multiple step income statement. Remember, it reports multiple levels of profitability. Gross profit equals net revenues minus cost of goods sold. Operating income equals gross profit minus operating expenses. Income before income taxes equals operating income plus any non-operating revenues and non-operating expenses. And then net income equals all revenues minus all expenses. Okay, pretty straightforward. Again, keep a multiple step income statement beside you so you understand the different levels. And which profitability is considered profit from normal operating income? From normal operations, it's operating income. Okay, sorry about that. Now, here's the key today. The focus is on various types of inventory costing methods. Inventory is unique and diverse. There's all kinds of inventory out there, but companies are allowed to show the costing of inventory based on a couple specific methods. One is called specific identification, and this is primarily used when the inventory is very unique. So it's not like selling a bunch of Dell computers. This is where it might be a piece of jewelry or a home or an automobile, where specific identification matches each unit of inventory with what it actually cost to produce that piece of inventory. Another type of method is FIFO, first in and first out. Now that assumes the first items that have been purchased are going to be the first items that get sold. Usually that is physically how it happens, but just because it physically happens that way, you're allowed different ways in which to account for the cost. Last in, first out, we call LIFO. LIFO assumes that the last units purchased are the first ones sold. Now we know we're not going to sell them that way. We're going to get rid of our older inventory first, but we can show the costing in the financial statements that way. Then there's weighted average cost, where we take all the units and we put a weighted average on them, which we'll talk about in a minute, and all of the units get that same price. So here we have Mario's Game Shop. This shows us we started the year with beginning inventory of 100 units. Then it shows that we purchased on April 25th, 300 units. And we also purchased on October 19th, another 600 units. But as you see, they're all different costs. So the first 100 units are cost at $7 per unit. The next 300 are at $9 a unit. And then on October 19th, that one is at $11 per unit. So we have 1,000 units at a total cost of $10,000. Does that make sense? What if during the year we sold 800 of these units? Okay, that's the plan. If we sold 800 of those units and there's 1,000 units available, then that means if we sold 800, we have 200 remaining in ending inventory. So we're going to look at these different methods. The first method we're going to talk about is called the FIFO method. The first inventory in is the first inventory we're going to sell. FIFO, first in is the first out. If in fact we sold 800 units, wouldn't we sell 100 units at $7, 300 units at $9, and then 400 units at $11? The first ones in are the first ones we're selling, which means the ending inventory are going to be the very last units because they're still sitting in inventory. Does that make sense? FIFO, the first units that we purchased are going to be the first units we say were sold. So if we have 1,000 units, the first 800 are what we're going to show were sold. If we use the method called LIFO, then the last units we purchased are the first units we're getting rid of, that we're saying, not physically, but what we can say for cost purposes. So 800 units means the ones we purchased at the very end in October for 600 units at 11 are going to get sold. And then the 200 out of the 300 units in April, 200 units are going to be sold, which means what's left in ending inventory would be the oldest units, the units from the beginning inventory, and 100 units from the April 25th purchase. Does that make sense? So what this is doing is we've got to earmark which ones are we selling, so we can show what went into cost of goods sold and what's staying in the balance sheet as an asset. Many students find it shocking that companies are allowed to report inventory cost using assumed amounts rather than actual amounts. Nearly all companies sell their actual inventory in a FIFO manner, but they're allowed to report it as if they sold it in a LIFO manner. And we'll explain why that matters in a little bit. Okay. Now, how about this one? I want everyone to attempt this one. I'm going to give you a couple minutes to attempt this.
Is it B?
Someone said, is it B? Has everyone done it yet? I'm going to wait till everyone looks. So someone kind of gave you a heads up. It could be B. Anyone else have another answer? Anybody? Anybody? It's B? Okay. How did we come up with that? Again, FIFO means the first ones in are the first ones we say we sold. So if we sold 120 units, we take the oldest one sitting in inventory. The beginning inventory shows 100 units at $4 each. So we'll take all of those. And then the January 15th purchase will take 20 of those units at $5 a piece. Does that make sense? So our cost of goods sold here would be $500.
So if it was Lifo, I'm just trying to make sure I understand, because these are the ones I have the hardest time. If it was Lifo, we would take the oldest 100 units at $6, right?
Well, the newest 100 units, yes, at $6.
The oldest is the newest.
Well, okay, I'm sorry. The most recent purchases.
Okay.
Yeah, sorry.
Okay, and then we'll take, so basically we'll take the end of it.
Exactly,
Okay.
exactly. So let's do that one. Okay, this one says, what would be the cost of goods using LIFO?
Is it C?
C is correct. We're going to take 100 units at $6 and 20 units at $5. Okay. Now there's another method. This is called the weighted average cost method. We're going to take all the units and come up with a weighted average of the inventory items. The way we do this is we take 100 units at 7, which means we spent $700 to purchase those units. 300 units at 9 means we spent $2,700 on the April 25th purchase. On October 19th, we purchased 600 units at 11, which shows $6,600. We have 1,000 units at a total cost of $10. If we divide that 10,000 by the number of units available, we come up with $10 a unit. The reason the weighted average is important is because if we just look at the unit cost of 7, 9, and 11, the average here would be 9. But we spent a lot more. We have a lot more inventory at 600 units at $11. Therefore, the weighted average is what we need to take to accurately depict $10 per unit. Now we'll use that same amount. $10 per unit is going to get put in the cost of goods sold, and $10 per unit will be put in the ending inventory. So here are the 3 methods we've talked about. You see, using FIFO, we show the cost of goods sold is sitting at $7,800, but the ending inventory is sitting at $2,200. If we use LIFO, the cost of goods sold is higher because we're taking the oldest units that cost more. And our ending inventory are the units that we've had longer. If we use the weighted average method, it will always be in between the two, LIFO and FIFO. Does that make sense? Companies are allowed to report inventory costs by assuming which specific units of inventory are sold and not sold, even if this does not match the actual flow. The 3 major inventory cost flow assumptions are FIFO, LIFO, and weighted average cost. any questions on this before we move on? Okay. Now, why does all this matter? Well, when we use FIFO, that's basically matching the flow of goods with what we're truly doing, and the cost and the flow to go together. Most companies do use the FIFO method. We call the FIFO method the balance sheet approach because our balance sheet is going to most accurately reflect the most current costs. If we use the Lifo method, we call that the income statement approach because our income statement is going to use the most current prices. The Lifo conformity rule basically says if a company uses Lifo for income taxes, they have to use Lifo for financial reporting. You can't have it one way and then get to opt to make your financial statements look better. So what's all this about? Well, when prices are rising, if we use FIFO, our ending inventory is higher on the balance sheet. It makes us look like we have higher assets. We're going to also have higher net income when prices are rising. If we use Lifo, we're going to have a smaller amount of assets in ending inventory, but lower net income on the balance sheet. And the weighted average will always be a combination of the two. So the Lifo versus FIFO can make a difference on your assets and can make a difference on net income, depending which method you use. So most people show their accounting books in FIFO, but if they choose to record it in Lifo, they create a journal entry to show the difference. They report it using FIFO, but they report the difference called the Lifo difference as to how that affects their financial statements, which we'll look at. Okay, so guys, what do you think? During a period of rising prices, which inventory cost flow assumption would result in the highest cost of goods sold and thereby the lowest net income? Lifo, exactly. What about this? And which inventory method or cost flow assumption most closely resembles the actual physical flow of goods?
Is it A?
Lifo?
Yes.
Excellent, FIFO. So now let's look at the meat and potatoes of how we go about recording these journal entries. There's two methods. One is called the Perpetual Method, where we keep a track after every transaction. And one is called the periodic system. It basically adjusts at the end of the year for cost of goods sold. So we're going to look at both of them because homework, you'll have both. Using a perpetual system, means we keep the inventory updated after every transaction. So on April 25th, when Mario purchases inventory for $2,700 on account, we're going to debit our inventory and we'll credit our accounts payable right away. Okay. Then this entry shows an increase in inventory and an increase in a liability. Makes sense. Next, on July 17th, Mario sells inventory on account for $4,500. What are we going to do? There are two transactions we're going to do when inventory is sold using the perpetual method. First, we're going to show the sale of the inventory. And then after that, we also have to take into account the cost of goods sold that are no longer in inventory, that have gone to cost of goods sold. We debit that for $2,500 and we reduce our inventory for $2,500. Okay. So sales revenue basically equals the selling price, and the cost of goods sold is the expense. The selling price is what we're selling the products for. The cost of goods sold is what it cost us to purchase or make those goods. Now, this inventory, we see Mario began with 700. They had purchases of 2,700 and 6,600, and they sold two different times on January 17th and December 15th. We've got sitting in the account FIFO, based on FIFO, of 2,200. Now, remember me talking about that LIFO adjustment when companies choose to do LIFO? They usually record their books using FIFO, but there's a year-end adjustment that adjusts it to LIFO, which we call the Lifo Reserve. Remember, Mario's ending inventory using FIFO was 2,200. But if they would have used FIFO, excuse me, if they would have used LIFO, it would have been 1,600. So it would have been $600 less. So in order to look at the LIFO adjustment, we would show a debit to cost of goods sold of 600, and we would credit our inventory for 600 to adjust to the LIFO method. Okay. Does that make sense, guys? Okay. Now, there are some additional items that go into inventory. Freight in are shipments from suppliers that we pay for, and freight out, shipment to customers we pay for. There's also something called purchase discounts, and there are purchase returns. So we're going to talk about how these various transactions affect our inventory. So when there's some terms with shipping that we want to talk about. When Mario purchases items from the supplier, the seller, and if the items are shipped saying FOB shipping point, what that means, it's free on board to the shipping point, which means the supplier's warehouse. What that means is Mario's responsible for paying the shipping cost. So because Mario's paying the shipping cost, the title of those goods passes to Mario at the shipping point when they leave the dock of the suppliers. If this is the case, then Mario's going to record this purchase of goods on April 25th because it owns those goods at that time. If the shipping shows FOB free on board to the destination, then what that means is the supplier is responsible for those goods until it gets to Mario's warehouse, Mario's dock. In that case, the title passes to Mario when they receive the goods at the destination at Mario's warehouse dock. If that's the case, then Mario would record the purchases on April 29th. So depending on how the shipping instructions work depends on when we will record this transaction. Which of the following transactions would increase the balance of the inventory account for a company using the perpetual inventory method? What do you guys think? Anyone? Which of the following would increase the balance of inventory? Costs of incoming freight charged on merchandising inventory? That would increase it, wouldn't it? A return of damaged inventory to the vendor would decrease it. A purchase discount taken for prompt payment would decrease it. And shipping charges for outgoing inventory would decrease it. So no, what increases it is costs on incoming freight. So here you see Mario showing on the income statement the various items, excuse me, this isn't on an income statement, it's just showing the detail of the cost of goods sold, showing we add freight charges to inventory and we would subtract any purchase discounts we receive because we pay early. We talked about that, I believe, the last chapter or one of these chapters. Okay, so let's look at how the various transactions are recorded with the buyer and with the seller of these goods. So when we look at the purchaser, the one who's buying these goods, we see that when we purchase goods on account, the buyer is debiting inventory and crediting a payable. The seller debits accounts receivable and credits sales revenue. Now, if the buyer returns some products, then their accounts payable is decreased and their inventory also is decreased. You see, they just reduced their inventory, but the seller side wants to keep track of any returns that happen. So they debit sales returns and credit their receivable. When the purchaser finally pays, they're going to debit the payable. They're going to credit the inventory and credit the cash. They're crediting the inventory because the inventory isn't going to cost them as much because they're paying early. So the inventory has less cost. However, the seller wants to keep track of how many people utilize the sales discounts. So they will debit the cash, they will debit the sales discounts, and credit the entire accounts receivable.
Can I ask a question?
Yes.
So I've noticed, or maybe I could be wrong, but when there's a return for an item, I just feel like I haven't noticed, when do you account for in the statements? When do you show that there was the return?
Right when they receive it. So the return will happen on either the purchaser's or seller's side, right when the purchaser sends it back or the seller receives it. They will show it. Now the purchaser will just debit the payable because they now owe less and credit their inventory, but the seller is going to be careful and show it was a sales return.
Okay.
Because they want to keep track of, are there certain goods that are getting returned more than other goods? Maybe something's wrong with them.
Will it still stay balanced even though? 'cause I
It
guess
still
with
will
the
stay
return, it'll be
balanced.
showing it. Okay.
Yes, it
But
was,
you don't really, because you know how, like when you wrote off debt,
yeah,
for people not paying it.
yeah.
What do they, I guess this is going overboard, I overthink stuff, but what do they do with like the items and stuff at that point?
Well, the item's already sold initially. So the sale occurs when the goods transfer, when the goods pass. So nothing changes because those goods are gone unless the an auto dealer goes and confiscates those goods and gets it back. But usually speaking, in this scenario, the goods are gone. Okay, so all we're doing is adjusting the accounts receivable to allowance. In this case, they are returning the goods. So we need to keep track of, you know, each when it happens. Okay, so guys, we are going to do an exercise here. And I'm gonna take a quick run to the bathroom while I want you to attempt these. You see, DS Unlimited has the following transactions during August. On August 6th, it purchased 70 handheld game devices on account. On account means accounts payable for $200 each. Then on August 7th, it pays $400 to Sure Shipping for freight charges. Then on August 10th, it returns 6 game devices that were defective. August 14th, it pays the full amount. And then on August 23rd, it sells some. So I want you to go through this. I'm going to just put the recording on pause. So on August 6th, when DS Unlimited purchases 70 handheld game devices on account, we're going to debit our inventory for $14,000 and we're going to credit our accounts payable for $14,000, purchasing inventory on account. Okay. When we pay the freight with cash, we're debiting inventory and crediting cash. Then it says we returned some goods, I believe is what it said. We returned 6 game devices that were defective. We're going to debit accounts payable for $1,200 and credit our inventory for $1,200. When we finally pay our bill, we utilize the discount. So we're going to debit our accounts payable. We are going to credit our inventory for the 1% discount because we're not paying as much as we thought in our inventory. And then we're going to credit our cash.
Real quick, the 128 is coming off the original inventory price?
The less what we returned.
Okay.
Less what we returned because we already returned goods. And so we're going to, because we started with 14,000, we returned 1,200. So we had 12,800 we needed to pay on. Then when we turned around and sold those goods, we're debiting our receivable for 11,000. We're crediting our sales revenue. And then there's an additional journal entry, getting rid of our inventory to show it was sold. We debit our cost of goods sold for 10,000 to 1250. And we credit our inventory for 10,000 to 1250. Any questions on that, guys? Any questions? Okay. Now we're going to look on the other side of the equation here, and let's look at Game Girl. Prepare the transactions for Game Girl, assuming the company uses a perpetual system. Assume the 70 game devices sold on August 6th to DS Unlimited had a cost to Game Girl of $180 each. The items returned on August 10th were considered worthless to Game Girl and were discarded. So when we sold the goods, we debit the receivable, we credit the sales revenue. Then we also debit our cost of goods sold and credit our inventory for that amount. Okay. Next, when the products were returned, we debit our sales returns and we credit our accounts receivable. Then when we received the money, we debit our cash, we debit our sales discounts, and we credit our accounts receivable of 12,800. Remember, they took the discount. Okay. Now there's something else we're going to talk about as it relates to inventory. We're aware of the term cost. That's what we usually show the inventory at. But there's a new term now we're going to use called net realizable value. And basically what that means is cost is what we purchased the items for. But net realizable value is the estimated selling price less any cost to sell the goods. If net realizable value is lower than cost, we will then need to adjust our books to account for the lower price. If the lowest price is cost, there's nothing we need to do. But if it is net realizable value, then we're going to have to reduce our inventory from cost to net realizable value and show an expense on the income statement. So here's an example, guys. This game store has two devices, a Fun Station 2 and a Fun Station 3. It looks like the new one is out now, so it kind of makes the Fun Station 2 a little obsolete. So we're going to look at them and we're going to see, hey, is what's lower, cost or net realizable value? If the cost is lowest, we do nothing. But if the net realizable value is lower, we need to adjust our books by showing a debit to cost of goods sold, and we reduce our inventory by that amount. Remember, if cost is lower, there's nothing we need to do. But if net realizable value is lower, then we need to adjust the books. Okay?
What, can you like show me which part you're saying is lower?
Okay, you see here it says cost, and this says net realizable value.
Yeah,
In this
Oh, yeah.
example, which is lower? Well, the 3,000 is lower than the 4,500. So we need to adjust our books
okay.
to net realizable value and do a journal entry. So guys, look at this one. At the end of the year, a company reports the following inventory amounts. The amount to report for ending inventory using the lower of cost and net realizable value is what? Two or B or D? Okay, I want everyone to tell me what you think. Anyone have an idea? So on item A, the cost is 4, the net realizable value is 8, which is lower.
Cost.
Don't need to do anything. Item B, the cost is 8, the net realizable value is 6. Do we need to do something?
Yeah.
We do. We need to reduce it by $300, right? So that would mean that our new cost in inventory is 150 times $6. And item A is 100 times $4, 1,300. Does that make sense?
Item B, 150 times 6, and then item A, what'd you say?
100 times 4.
Why are you doing it that way?
Remember, it's the cost, the lower of cost or net realizable value. It's asking us, what's our inventory? Well, it's going to be 100 times 4 and 150 times 6.
Because those are the lowest ones.
Those are the lowest ones. Okay. How about this one, guys? At the end of the year, a company reports the following inventory amounts. The year-end adjustment using the lower of cost and net realizable value would include what? What's it going to include there? Come on, guys. What's it going to use? Won't it be a credit to inventory for 300 and a debit to cost of goods sold for 300? Right? Because of the net realizable value, won't we be adjusting those? Okay. Okay, so we're going to look here. A company like Golf USA that sells golf-related inventory typically will have inventory items such as golf clothing and golf equipment. As technology advances the design and performance of the next generation of drivers, the older models become less marketable and therefore decline in value. Suppose that in the current year, Ping introduces the Mega Driver 2. the new and improved version of the Mega Driver. Below are amounts related to Gulf's USA's inventory at the end of the year. Calculate ending inventory using the lower of cost or net realizable value. Record any adjustments to inventory and explain how this affects the financial statements. I want everyone to give you 5 minutes to attempt this, okay? Okay, let me pause. And Angel, you're going to remind. Okay, so guys, calculate the ending inventory using the lower of cost or net realizable value. The shirts, the lower of cost or net realizable values cost. The Mega Driver, the net realizable value is the lower number at 250. So that's what we're going to use. And the Mega Driver's at 350. So you see our ending inventory sitting at 16,350. The way we need to adjust it is write down on the Mega Driver the difference between the cost and the net realizable value. We need to debit to cost of goods sold and reduce our inventory. And how does this affect us? The write down of inventory basically reduces our assets and also reduces our net income, right? Right? Decreasing net income and decreasing retained earnings. Okay. Now, there's a couple ratios I'm going to let you do on your own, the inventory turnover ratio and the gross profit. I'll let you do that on your own, but there will be some homework on that, just so you know. But what I want to focus on is this last piece. The last piece is using the periodic system. So we've talked about how we use the perpetual system. But the periodic system has a bunch of different accounts we're going to use. So we need to look at this. Remember, the periodic system doesn't take into account cost of goods sold till the very end. Okay, so what we're going to do using the same information is under the periodic system, we don't call it inventory. We call the account purchases when we purchase items. When we sell items, we don't show the reduction of inventory and the increase of cost of goods sold. We deal with that at the end. We only show the accounts receivable and the revenue. Then on freight charges, instead of increasing the inventory, we debit our freight in. Okay. Then when we pay with a discount, instead of reducing our inventory, we type out the word purchase discounts. And when we return items, instead of just crediting our inventory, we credit purchase returns. I think it's important that you guys have a little sheet that shows the difference between the perpetual method and the periodic method, because the names used are different. Okay. Okay, does that make sense? Only under the periodic system do you have to do an adjustment at the end of the period. you need to show the ending inventory. And the way we do that is we get rid of, records the cost of goods sold for the period, and these accounts, purchase discounts, purchase returns, freight in, and purchases all get zeroed out. Okay, they all get zeroed out. We know what the ending inventory amount is. We know what the beginning inventory amount is, and the rest goes into cost of goods sold. So only under the periodic method do we handle this adjusting year-end entry. Under the perpetual method, we keep track of it as we're going along. So this shows you, using the periodic method, how your cost of goods look. You have a beginning inventory, you add your purchases and freight in, minus purchase discounts and returns to get all your costs ready for available, less your ending inventory is going to give you what your cost of goods sold is. It's different. The accounts used are different, as you can tell, okay? Got it, guys? Okay. When a periodic inventory system and the Fifo method are used, which of the following is correct? What do you guys think? Anyone? Did you say B? Go Angel. The amount of cost of goods sold will be the same under a perpetual system and the Fifo method. Now, here's our last exercise. We're using that same company again, the same transactions, but we're going to do this using the periodic system. When we make purchases, guys, we debit our purchases and credit our payable. When we have freight, we debit freight in and credit cash. When we return items, we debit our payable and we credit purchase returns. When we sell when we pay for the product, we credit or debit our accounts payable, but we also credit purchase discounts. Then when we sell products, we don't handle the cost of goods side. We just do the sale portion, our accounts receivable and our sales revenue. Now, how do we do the adjustment? We know our ending inventory, okay? So we zero out our purchase returns, our purchase discounts, our purchases, and our freight in, transfer that into cost of goods sold, and we're going to balance out. Since there was no beginning inventory here, we didn't have to zero that one out. Now, when errors happen in inventory, in the end, over a 2-year period, it's all going to balance out. But 1 year will overstate one item and understate another item. So when there is an overstating of your ending inventory, what does that do? It overstates your ending inventory. It understates your cost of goods sold, which ultimately makes your net income higher. So what they're wanting you to understand is there's an effect on the balance sheet and the income statement when the numbers aren't correct. If you understate your ending inventory, then the asset inventory is understated, but your cost of goods sold is overstated, which makes you have a lower net income. It understates the net income. No, ultimately, it's going to balance out. But between the years, it's not going to be perfect. Do you see this? If our inventory is overstated from one year to the next, here, let's say this is the correct amount. This is understated. If our inventory gets understated, then you see our cost of goods sold gets overstated. So know that between the years, it's all going to balance out fine. But over the 2 years, it's going to balance out fine. But between year 1 and year 2, the numbers aren't going to be correct. In the current year, inventory errors affect the amounts reported for inventory and retained earnings in the balance sheet and amounts reported for cost of goods sold and gross profit in the income statement. At the end of the following year, the error has no effect on ending inventory or retained earnings, but reverses for the cost of goods sold and gross profit. So over that 2-year period, it's going to be fine. Okay, what about this one? An inventory error that understates the amount of ending inventory will result in which of the following in the current year? A? Anyone else? Someone else said A. How about you guys online?
I'd say A.
A. Awesome, guys. Any questions before I turn off the recording? You guys good?